Standard financial reports are excellent at documenting what has already happened. They capture past expenses precisely. But when you try to predict how a shift in sales will impact your bottom line, their rigid structure fractures under the pressure. To accurately forecast profit, management has to step away from traditional functional grouping and adopt an internal reporting format known as the contribution margin income statement. This diagram shows the structural difference between the two approaches. On the left, the traditional statement groups expenses by department, placing costs into buckets like cost of goods sold and administrative. On the right, the contribution margin format separates expenses strictly by how they behave, either variable or fixed. To build this statement, you need 3 raw materials: a blank spreadsheet, your total sales revenue, and a list of expenses pre-categorized as either fixed or variable. By reorganizing financial data around cost behavior, we establish a direct link showing how each new unit sold manipulates your operating profit. The absolute starting point for our statement is the total sales revenue generated during the accounting period. We open our spreadsheet and record this revenue figure directly on the top line. Every categorized cost we identify from here on out will be deducted from this master number. Step 1 is building our first subsection, dedicated entirely to variable costs. Variable costs change proportionately with activity volume. Sell twice as many units, and these costs double. We log 2 items: variable cost of goods sold and variable selling and admin costs. We add these together to establish total variable costs. When doing this, you have to avoid the common COGS trap. Your fixed cost of goods sold must never be included in this variable section, even though it relates to production. Isolating these variable expenses first strips away the operational noise. It exposes the true, immediate cost of scaling your production volume. With our top line and variable set, we arrive at the primary mathematical pivot of the entire document, calculating the contribution margin. As this formula overlay shows, we find this metric by taking our sales revenue and subtracting the total variable costs. The resulting number is your contribution margin. It is the exact pool of sales revenue that survives after all volume-based expenses have been paid. The sole purpose of this leftover money is exactly what the name implies. It exists to contribute toward paying off the organization's fixed obligations. This margin is the tipping point for a business. Once the contribution margin grows large enough to cover the fixed baseline, every subsequent dollar flows purely to profit. Now we shift our focus to the bottom half of the statement and our second category of expenses, the fixed costs. Fixed costs are the expenses that remain stubbornly constant in total, regardless of whether your production activity scales up or down. Looking below our contribution margin, we create a new subsection and log the fixed cost of goods sold alongside the fixed administrative costs. We sum these static expenses to calculate our total fixed costs. We are ready for the final step to complete this report. We take the contribution margin and subtract total fixed costs. This final line gives us operating profit. A positive number means you are profitable. Below 0 is a loss. This final deduction mathematically proves whether your current sales efficiency is actually powerful enough to carry the heavy weight of the company's fixed architecture. The statement is complete. Notice how clearly the cash inflows, the variable drains, and the static fixed obligations are separated from one another.